Alright, guys, so this is a big one. China has dealt a major blow to the US economy. No, it isn't some new tariff. Nope, China didn't impose yet another export ban. Beijing just hit America where it hurts the most, which is the US financial system. This is the beating heart of the hegemonic framework that requires the world to participate in or else. This is a chart of US federal debt. The US government has borrowed nearly 100% of GDP today. But in 2035, this debt will snowball and reach nearly 120%. By then, the US would owe the world $52 trillion, which is literally insane. This is money and wealth trapped in the US bond market that can't be used elsewhere. But why are people lending the US government money? Now, thanks to decades of the US economy staying on top, many investors they've been rushing into US assets. Thanks to the dollar being the reserve currency, the knee-jerk reaction is to recycle your savings into American stocks and bonds. Now, we have seen this multiple times in the past, especially in times of crisis. The default is to sell your local assets and buy stuff denominated in US dollars. Even in US corporate bonds, which is debt issued by American companies, foreigners are buying in. In Q1 last year, nearly 200 billion was poured into US corporate debt by overseas investors. And this is money that US companies need to fund their operations to expand their business and pay salaries. And why do you think US bond yields aren't through the roof yet? Why are stock valuations so insanely high today? It's all because of foreign money propping up the financial system. This might be a sign of strength, but it's also a major weakness, especially when the world is losing trust. We just need to look at what Trump is doing to the reputation of the US economy. He has imposed senseless tariffs on adversaries and allies alike. He wants $500 billion of resources from Ukraine. But what really takes the cake is Donald Trump's threat to BRICS.
If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency, we're not going to salute the dollar anymore, I'll say, that's okay. You're going to pay a 100% tariff on everything you sell into the United States. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing, that's not even chess, that's checkers.
So if you're on the receiving end of such a threat, you know your days are numbered. And now China has flashed a big Batman signal to the global south that they are pushing their economy away from US assets. Beijing has now instructed their insurance giants to move money into precious metals. In other words, China just told the biggest custodians of public money to exit US assets and buy gold. This is the subtext, and we must not ignore this. Companies can break away from their mandate and put up to 1% of their assets into precious metals. And this will free up almost $28 billion for gold investments. This is starting with 10 insurance companies, and it's just a start. It's not good for the US economy. Trump really did it this time. But it's good news for the global majority. China is showing the world that they can actively de-dollarize their economy, starting with the financial sector. And they are doing it with their people's money. It's also a reminder for other countries to move away. You have to de-dollarize, and this goes beyond just using local currencies in bilateral trade. That is the basic layer. Sooner or later, you need to graduate and diversify away from US assets. And this is the beating heart of the US financial system, and is something that Washington is terrified of, and here's why. In early 2024, foreign countries owned 7.9 trillion in US treasuries alone. That's 23% of total US debt, of which more than 50% comes from central banks and government entities. The other 50% comes from private investor money. China is showing the world that you can divest from US assets in both central bank holdings and private holdings. This is a game changer because the playbook is now public. Just think of all the private entities holding trillions of dollars. We have insurance companies, pension funds, and commercial banks. And let's not forget sovereign wealth funds that usually buy US bonds month after month and year after year. Many Chinese insurance firms invest a ton of money in Western assets. Unbound insurance, for example, bought the Waldorf Astoria Hotel in New York in 2014 and they spent $2 billion. Ping An, another insurance giant, has poured money into US tech firms and EU real estate investments. Now, in a globalized and peaceful world, this isn't strange, it's just diversification. But the Chinese government, well, they now have different plans. They essentially told Chinese insurers and other investment firms that they want them to move money into gold. Instead of investing in US assets, it's time to buy a neutral reserve asset. Gold is something that China's central bank, as we all know, have been accumulating for years. China wants gold prices to go higher. Now, just by itself, China has an incredible capacity to de-dollarize their assets, and they are beginning to fire on both cylinders, and the insurance sector is no slouch. In Q3 last year, the total assets of insurance companies totaled 4.9 trillion US dollars. What's terrifying is the speed of the increase of assets under management. In just 9 months, Chinese insurance companies grew the amount by over 11%. That is a phenomenal increase. As China's middle class continues to grow, this will only fuel the dollarization. Good news for gold prices because more money is going to flow there. But how about the Chinese government's wealth? It's even more overwhelming than the private sector, and President Xi can direct it to whatever asset he wants. This is a command economy after all. China's trade surplus has grown to an incredible $1 trillion a year. While the majority of the surplus comes from the US and the EU currently, Trump's tariffs won't really reduce this. 80% of stuff in Walmart are from Chinese suppliers. And there's a reason why Trump only dared to hit China with a 10% additional tariff. Chinese goods can't be replaced easily, and trying to do so now will spike inflation. But look at the surplus from Southeast Asia in blue and the rest of the world. Those parts are growing fast over the past 2 years, which means China's $1 trillion war chest would continue to grow. Apart from investing in the Belt and Road projects and boosting domestic demand, China will have to invest their reserves somewhere else. Most likely, this will involve buying gold and supporting their own market. When the government says something, public and private companies all see this as a directive. It's not just a recommendation, it's more like an order to get things done. In a radical move, Beijing is telling their insurers to buy more Chinese stocks to move money away from Western assets to support their own equity market. And here's how significant this move is. Regulators have told state insurers to invest a minimum of 30% of new policy premiums in local shares. In addition, mutual funds have to grow their stock holdings by 10% for the next 3 years. This is a very solid target, which is quite shocking to say the least. It would unlock $68 billion into Chinese stocks from China's three biggest insurance giants alone. So make no mistake guys, this is a big move and it is a game changer. Beijing wants Chinese money to stay within the country and benefit their own financial markets and not America's. So we can expect more flows into either gold or Chinese stocks. US assets will be shunned. This is the effect of Trump's trade war. He's making the confrontation between the US and China's economy even worse. While tariffs could damage Chinese exporters to a certain degree, Beijing wants to clobber the US where it hurts to deprive the flow of money into US assets. The problem the US faces is the burden of the national debt. Now, just yesterday, the Federal Reserve, they refused to cut interest rates, and this pushes interest payments higher for the long term. Since June last year, US inflation has been staying extremely sticky. Core inflation has been staying at 3.2 to 3.3%. In fact, January CPI is seen rising for the fifth time in 6 months. Now you add in Trump's tariff war, everything from cars to Chinese imports will rise in price, and it adds even more upwards pressure on inflation. Bond yields across the board are going to stay higher than usual. This isn't good for US consumers looking to spend or for companies looking to grow. But worst of all, this is bad for the US national debt. And that's why Trump is demanding rate cuts during his tariff war. He knows the debt burden is unsustainable. Over the next 10 years, the US will have to unleash a tsunami of borrowing to fund Trump's tax cuts. Now, Trump wants to lower taxes for the rich and bring in foreign companies, But that could leave the US with a 11 trillion black hole, and once again the money would have been borrowed from foreign investors. But will foreign buyers be around to drive demand? Or will there be only reluctant buyers asking for higher return? That is the trillion-dollar question here. We know China would rather buy gold. G7 allies might be buying US treasuries today, but will that last? If Trump keeps hammering their economies, demand here would eventually evaporate. And if that happens, the debt will explode even higher, and the US would have very few options to fall back on, and either solution might trigger a disaster. This shows the holders of US debt today, foreign investors, including central banks, they hold $8.7 trillion worth. But if these buyers walk away, who else will buy the debt? US agencies buying is just the left pocket to the right. And if the Federal Reserve buys, that's basically money printing and will cause another inflation problem. So the burden will fall on local US investors, US pension funds, mutual funds, and people on the street. They will have to buy the debt. And when the default comes, when day X comes, their wealth is going to evaporate. It won't be foreign holders that loses the most, but domestic investors in the US itself. So there's really no happy ending to this situation. It's the reason why Doge is trying to desperately cut expenses because the US government can't afford to borrow money to blow up the debt even further. Now, can this situation be reversed? Yes, but it will take a titanic effort. Firstly, the US government has to stop spending money. They would probably have to embrace a recession as well. And more importantly, to attract back buyers of US bonds, Trump will have to stop his tariff war. And that includes trying to weaponize the US dollar against China and the BRICS. But let me know what you think. Will China continue de-dollarizing their financial markets and economy? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.